Let's dive a bit deeper into the markets with Charles Schwab, Chief Investment Strategist Ann Sonders. Ann, I hope you won't mind me dragging you into that discussion about sideline cash and whether or not you think it's important, at least this year, next year, on an index level.
I 100% agree with everything that Mike said. I think that is stickier money in the sense that it's come from more traditional deposits and or maybe even places where investors had gone in the low rate environment to pick up yield. Now they can do it in the safety of something like money markets. The percent of total market cap is fairly low relative to history. And it's also the case, and I don't think Mike mentioned this, that if you want to find reasons to be bullish on the equity market, it doesn't necessitate a move of some or even any of that money going from money markets into the equity market. For much of the 1990s, you had a simultaneous move up in money market assets and the equity market. So I agree that I disagree with people who are putting a tremendous amount of weight on that as sort of a prospective reason to be optimistic about the market. I think the market can do well, but not necessarily because that money has to shift gears and move into equities.
Right. That's pretty interesting. Interesting also that the Journal gave it so much play today. As for yields, Ann, how much are you on guard to see if at least the 10-year dives deeper into the fours and starts to challenge our assumptions about not just the pace of Fed cuts, if there are any, but the pace of inflation as well?
Well, I think yields are still in the driver's seat. I don't think we'd break that relationship, at least in the near term. And by near term, that probably carries through to at least the March meeting when we actually see what the Fed does. And in particular, since the midpoint of last year, that connectivity has been extraordinary with the move up in the case of the 10-year from sub 4 to 5%, directly corresponding to the correction from late July to late October in the S&P, a slightly bigger correction in the NASDAQ. And then you had the flip back and the boomerang in yields from 5 back down to sub 4. That gave not only a lift to the overall market, but really was fuel for small caps because of that greater sensitivity to moves in yields. And a lot of people are thinking about the calendar year turn as some reason why the market has struggled a little bit. I don't think that's it. It's just coincidentally, maybe you saw the bottom in yields occur right at the end of December. December 28th, I think, was the date for the 10-year. And sure enough, you've seen choppier action in the cap-weighted indexes or the larger cap indexes and much weaker performance in the small caps. And I think that tight inverse correlation between bond yields and stock prices is sort of the story, at least near term, and will continue to be.
Yeah, continuing from 2023. Tomorrow will mark actually a week of fourth quarter earnings season, which, speaking of choppiness, it's been kind of a noisy quarter out of the gate. Do you expect the rest of the fourth quarter earnings season to be kind of more of the same? We've seen some downward revisions, some mixed picture in terms of analyst notes and so forth.
Yeah, I think the downward revisions have been pretty notable. Right now, what they call the blended growth rate, which is the still fairly low percentage of stocks or companies that have reported. It's their actual results blended with the consensus for the remaining of companies. And that's obviously going to change on a day-to-day basis as we get more actual reports in. But that's down just a little over 4% right now. The expectation just as recently as October for Q4 earnings was 11%. So that's a pretty decent haircut. And you've seen not just the haircut for the quarter that we're currently reporting, but all 4 quarters in 2024 have been haircut down. Now, what ultimately may happen is analysts during earnings season cut so much that the bar ends up low enough that you get better than average beat rate, better than average percent by which companies beat. But I think it's that broader trend of we were probably a bit too optimistic heading into the end of the year and almost certainly too optimistic for calendar year 2024. So I think there's probably still more downside to go to sort of level set 2024 earnings to the macro backdrop.